Hey everybody, it's Erik Torenberg, co-founder, partner of Village Global, a network-driven venture firm. And this is Venture Stories, a podcast covering topics relating to tech and business with world-leading experts.
Hey everybody, we're now accepting applications for our Network Catalyst Accelerator program. Founders in our program have gone on to raise money from Lux, Spark, A16Z, Slow, First Round, SUSE, Homebrew, Mavron, Obvious, NFX, Signalfire, and many more. Learn more and apply at villageglobal.vc/network catalyst.
Hey everybody, welcome back to another episode of Venture Stories by Village Global. I'm here today rejoined by two very special guests, backed by popular demand, Ali Hamed of CoVenture and Brent Beshore of Permanent Equity. Brent, Permanent Equity is a new brand.
Yeah.
Unpack it a little bit for us.
Well, after I came on your show, I mean, my brain was so tarnished that I had to rebrand completely. So no, it's something we rebranded. Let's see here, 8 weeks ago, 6 weeks ago, something like that. I don't know times. I don't know what day it is right now. So, but we wanted to get a brand that more closely matched what we were doing. And to be frank, I was tired of having people ask me if we were based in Spain or, if it was adventure.es or, whatever the flavor of the day was. So, or our emails getting rejected from servers because it looked like we were spammers. So, but yeah, so we got Permanent Equity. Thank goodness for the foresight of Patrick O'Shaughnessy, who, when I first started talking to him, 3.5, 4 years ago now, about permanent equity. I kept using the term permanent equity, and he was like, I really like that. And then, he about a month later said, oh, by the way, I bought the domain. I think this is going to be a thing. And I was like, oh, that's cool. Whatever. And then I went to him, 4 or 5 months ago and said, hey, do you mind me snagging that domain back from you? So Anyway, yes, we're Permanent Equity, same company, same location, same philosophy, new name.
Cool.
So I've been trying to buy CoVenture.com for years, and the guy who owns it is represented by some attorney in Canada, and for whatever reason, they just won't come to the table. I'm like, guys, I'm a pretty motivated buyer. Let's have the conversation.
Well, I know they're listening to this, Ali, so I'm excited for them to come to the table, and Brent, I'm excited to put Permanent Equity on the map.
I mean, in this market, I think the price is definitely depressed a bit.
Yes.
But if they are listening.
I like how you're hedging already. That's fantastic.
Totally. Okay, so that's a great segue in this market. Ali, you wrote a blog post the other week talking about what the market means for the VC industry. Why don't we get in there? What does it mean? How should VCs be responding to it? And what does what VCs believe about what the future holds for this market determine how they should act as a result?
Sure. So I think the first reaction was in the venture community broadly, okay, the market's down. Why does that affect us? We're long-term thinkers, and this is going to last for a temporary period of time. But if you're investing in a company, you should have a 5 to 10 year view anyway. So who cares? And my comment back was, the problem is not that the market's down. The problem is the reason the market's down. And the reason the market's down is because everyone got sick. Some people died, so everyone else had to go home and they stopped buying stuff. And that's pretty bad, And so sure, the stock market's down, but that's not the problem. The problem is demand's down. And so the idea that this isn't going to affect venture capital, I thought was fairly naive. I think a lot of venture capitalists took it as an opportunity to market themselves on Twitter, which whatever, that's fine. People do that all the time. But I do think it was a little bit misleading to entrepreneurs. And so now, just like everything on Twitter, it's two different polar opposites. There's the, oh my God, if you're investing now, that's crazy because we're all on hold and whatever. And there's the other camp, which is if you're slowing down your investment pace now, you're just a tourist and you clearly don't have a long-term view. And the answer is somewhere in the middle. The answer is everyone in their portfolio who has a lot of portfolio investments. And, I use the word everyone, and it's hard to defend absolute. So inevitably someone's going to come up with a counterexample. Most people who have enough investments have a company that's totally fucked right now. And, the company may have lost 90% of its sales. It was a company that maybe was doing, $1 million of revenue a month. They had a net burn of $200,000 a month. They had enough runway for 18 more months. And now they have 4 months of runway or 3 months of runway. And they're not really sure if those sales are going to come back at all until they run out of cash. So VCs have to spend most of their time for, at least a few weeks figuring out how to create bridge rounds or solutions or layoffs for those companies. And then on top of that, because there's less demand right now, top line growth is going to slow down. Usually third-party financings happen because of 70 to 100% or more year-over-year growth. Some sort of new inflection point is reached. And many of these companies are not going to hit that inflection point this year, which means their valuation may not be able to go up, which means that their funds are going to have to do insider rounds for them, which means that funds have to go back and say, how much of my reserve capital do I have? Which means they can print less new names. So yes, less new deals will happen. Does it mean no new deals are going to happen? No, that's not true. We closed a deal on March 14th. We closed another deal on March 31st. We'll probably do 2 more deals in April. But, the opportunity cost of new dollars is low. And then the last thing is, I think a lot of entrepreneurs in normal times view it that if they do a down round, it's very scary for the market. VCs really love pattern recognition, partly because they're generalists and partly because they don't really know a lot, aside from people who focus on a certain vertical. Generally, venture capital is done by generalists who look for pattern recognition to decide if a deal is probably good. And they like to see a seed round and then a series A and then a series B with reasonable growth in between. And we've all come up with these like insane terms to kind of make things fit within that. We have seed extensions now and like series A extensions. That way, it all fits. It's a perfect story. A lot of entrepreneurs have adapted to that. And so when they go out and they need emergency financing, what they're doing is they're reopening their last round, or they're trying to avoid a down round because they know historically that's been really bad. I've now seen a handful of entrepreneurs try to do that and see all of their best prospects of investors just write back an email, not even taking the meeting. Hey, sorry, not for us. Because the market has adjusted and entrepreneurs, I think, haven't, either gotten rational advice of we don't know to optimistic advice to looking at Twitter and seeing everybody say, oh, our doors are still open. It's business as usual. And I think that's probably damaging people. We have seen people raise rounds exactly like they were going to before, but I think that's the minority, not the majority, because there's more risk in the market now. So I've just talked a ton, but that's sort of the summary.
Yeah. I got a quick question for you. How do you see opportunity costs in venture capital sort of impacting, the valuations of these companies? I mean, is there sort of an echo as other assets drop in valuation and sort of rise in attractiveness, depending on what you believe to be true about the world? How should somebody think about the opportunity cost and impacting valuations?
So I think, in other asset classes, it's probably easier to measure. So like in credit markets, spreads went up by, 700 basis points. And so then, in our credit fund, which we manage, we now know that if we used to target an X return, now it's like X plus N. I don't know what N is, but if you're one of our limited partners and you used to be thrilled about whatever return we were getting, and you were comparing that to like liquid ABS or liquid, high yield, and you needed some premium because we're illiquid, you would then say, well, if I used to be happy with that, but I can get a better return on my other portfolio, and that's what I compare you to, you now need a higher return. And you're going to see that all of our competitors in credit are doing the same thing. And then on top of that, I know that after 2 to 3 more months, defaults will start to occur. They haven't yet. And when that happens, if I invest $1 today, that means I have $1 less to invest tomorrow when yields have gone up. In venture, there is sort of that opportunity cost and new cost of capital that's being effectuated. But that's the short-term effect is because today I can do bridge rounds into really high-quality companies at really low valuations that I never used to get to do before. It used to be that if I was seeing some company in a reasonably large space that was growing and it was growing 100% year over year and it was doing 7 figures of top-line revenue, there was no way that deal wasn't going to get a bid up by a handful of firms. Now there's so much of that happening. There's so much triage that I'm getting to do deals that like I can't believe the luck. But it does mean that when another company comes to me, my opportunity cost, like I can still only do a certain amount of deals out of my fund. I probably will do more deals in 2020 than I do in 2022. But you have to compete for my attention with another company that I'm getting like a bargain on.
I think that's probably, I think that's an interesting point, and I think we're seeing that as well. Is there sort of intra-industry opportunity cost and then inter-industry opportunity?
Yeah.
Cost?
So what are you seeing in terms of like, the deal flow? Is it mostly emergency deal flow right now? Is it your portfolio? Like, what are you seeing right now?
Yeah. I mean, so if you have a solid company that's on good footing, you've got a good balance sheet, and you're not going out to market right now to sell your company. I mean, there's just no way. So you basically have a pretty nasty selection bias right now of companies that are trying to get sold, right? And we opened up something called Safe Harbor, which at the time looked helpful. The government has ended up just hammering that program because our cost of capital is going to be way higher than theirs. I can't,
Sure.
Unfortunately. And
although you actually have the competency to deploy it.
Yeah.
Like,
well, politics.
Like the SBA is like the DMV of finance. I have no idea how they expect people to the SBA program to actually deploy the capital they said they would.
So in all fairness, I've been, I would agree. And I've actually used that exact line in the last month. And I was really, really worried about it. To the credit of the SBA and the banks, we are seeing a lot more throughput and liquidity into the system through that program than I ever would have dreamed. That's
quickly. Great.
And so, I mean, look, again, politics aside about whether or not it should be going through them, it is. And so the reality is, how are they doing? And I'd say, to be honest, they're doing pretty well. I mean, we're talking to people daily who are have gotten their numbers. So the bank, well, the way it works is you apply to the bank then goes to the SBA and gets basically a guarantee code. And as long as it's a conforming loan, that guarantee code holds. And so that's kind of your place in line. And then you execute on the documents. And so
have you seen people get the amount they applied for, or have they? Because we've gotten a couple of people that we've been told the loan's going to go through, but we haven't been given the paperwork. And there's two main questions I had. The first is, what kind of consent do you need from your shareholders and your senior lenders if you already have debt? And the second is, sure, you got the loan, but is it the amount that you thought you were going to get? And I don't know if anyone has the answer yet.
Yeah, so we're seeing that the loans, so the banks are taking liberties to basically ask for different amounts of money than what people are, based on what they see in the documents. And so this is, again, where, depending on the skill level and the expertise of the bank, it can have a material effect on the amount, but both positive and negative, to be honest. I think they're trying to get it right, and they feel like they're on the hook for making sure they ask for the right amount of money. So I think there is some complication there. My understanding is that because it's unsecured and because it's 100% guaranteed, that you don't need consents, that it sort of bypasses consents of other lenders. And so we actually have not seen that be a problem in that segment of the market yet. And so, again, in general, I mean, I think that the program is working for what it's designed for, is actually working way better, exceeding my expectations. Now, the next round that just came out, announced yesterday, which is this sort of not a forgivable loan, but it's a $1 to $25 million 4 times cap on EBITDA amount that came out. It was part of the CARES Act as well, but it's sort of an execution of a different part of the CARES Act. That portion comes with a lot more strings attached, and I think is going to be interesting to see how companies react to that. And you've got another really interesting thing. So, all these programs sort of are an overlapping mosaic of advantages and disadvantages depending on what type of company you have, right? So that the one that came out yesterday is, it's all EBITDA based. So if you're not, making money, at least on an EBITDA basis, it really doesn't apply to you. And so, they're trying to, I think, target in some ways, and maybe I'm giving too much credit here, but I think they're trying to target certain types of industries with certain types of capital. And I would just ask, so what are you guys seeing in VC? I know the affiliation rules held, so that's created some challenges, but what are you all seeing in VC world on the PPP program?
Erik, do you want to go and then I'll go?
I think it's too early in terms of, we're seeing startups wrestle with sort of the ethical implications, ethical questions of, should they apply? Is it appropriate for them? I haven't heard any startups in our portfolio hear back from that program yet. And, I hear that it's quite a doozy to make sense of and to apply in the first place. Yeah. We're seeing most of them apply. We're seeing most of them say, hey, we were going to fire people if we don't apply. And so, the money's been allocated and we think it's appropriate.
Yeah, my philosophy is a job's a job's a job. If you're trying to save jobs, I think that, there's an argument to be made about which jobs should you save and is it delaying the inevitable, which I think in some cases it is. If there's a material downdraft in long-term demand and we think that the world's changed in sort of a sustainable way, than it's just delaying the inevitable. But I think there are jobs that are, you're just running into a solvency issue, which I think this does solve. And I think it's intended in those cases to be that. So, I mean, I don't have a problem at all with VC-backed startups applying for it if it helps save the jobs that they was intended to save.
So I've seen some of those sort of moral dilemmas, oh, should you really apply if you don't need the loan? I think anybody who knows that they don't need the loan either has a lot of cash or feels that they're smarter than a virus. That takes a lot of confidence to think that you're smarter than knowing how a global pandemic will end up and whether or not that'll affect you. And I think that if it turns out you apply for the loan and the pandemic is resolved and you didn't need the cash, then you should use the option, have the ability to donate the money later to someone who really needed it.
You don't have to ask for forgiveness on it. You can just pay your 1%, return the money.
Yeah, but make the decision later when you actually know for sure. Because I know if I was an employee of a company and the CEO is wow, as a sign of strength and out of righteousness, I'm not going to take money that was offered to us to keep us safer than we might otherwise be, I'd be pretty annoyed. I think that there's certain businesses that are wildly profitable. So it's, I think I saw a couple newsletters that said, maybe a hedge fund that has 5 employees and $1 billion of AUM shouldn't apply. Yeah, okay, I agree with that. But for most of our portfolio, and then it's not like VC-backed companies are backed by, these ultra-rich GPs who are going to be rich one way or another. No, the capital is being invested by endowments and pension funds and everything like that. And, that's the purpose of what this capital is out there for. Demand went down. You can now print money without as much risk of inflation as normal because you have so many deflationary factors. And the point, to Brent's point, is a job's a job is a job. And you should take capital that the government is providing to us, try to keep your employees safe.
I'm seeing a couple dynamics in VC right now. One is on the investing front. As Ali mentioned, we're seeing deals and other VCs are seeing deals that they tried to get in 6 months ago, a year ago, couldn't get into. Now it's open, just a little bit higher price or maybe the same price. And it's oh my God. So some deals, so it's a good time to be investing. At the same time, people are saying, hey, wait, is it going to be a better time to invest? 3 months from now, 6 months from now, 9 months from now, our price is going to, go back down significantly. That's one question people are wrestling on the investing front, how much dry powder to reserve. And it relates to sort of the LP front, which is if you were fundraising, you most likely paused. And the question is, are you, 3 months from now, 6 months from now, 9 months from now, is it going to be a worse time to fundraise, to work with LPs than it is now? It was sort of, the devil you don't know better than the devil you know if the devil is quite bad. Ali, what's your take on how VCs should handle those questions?
It's with humility and to say that you don't know, which is this could end up going 3 months or 6 months. It could come back. It could be so bad that we don't even know. So, we're picking our spots. I'm not going to deploy my whole fund this month, but, maybe when I see stuff that truly looks, unbelievable, I'll pull the trigger. I'm comfortable being too late than too early. And, my job is to be a reasonable fiduciary of capital to my LPs. And if it turns out that I didn't pull the trigger fast enough, but continue to have a 3-year investment period in which a majority of the deals come in and valuations will probably stay lower for a while, I can live with that. I can't live with putting a bunch of capital out now and then 4 months later, it all being gone. Brent, curious how you guys are handling that. And I'm sure, you're kind of struggling with the same issues.
And Brent, just to add to that, your own question of what do you believe about the world in 6 months from now, 12 months from now? How does that affect, your work?
Yeah, I mean, so I think that we don't know, and we are trying to have a high amount of humility. I mean, I think that we're constantly trying to triangulate and sort of calibrate what we believe to be true. But right now, I mean, the band of outcomes is just so dramatic that we just honestly, unless you have long-term government committed, contracts, and even those, I mean, could be reshuffled. I think the risk tolerance is just down a lot. I mean, and I think rightfully so. I mean, we haven't really talked about, the virus is one obviously heavy risk factor, but I think that it is going to be a more risk-on environment regardless. And I think that you will see, world actors that maybe have ulterior motives trying to shake things up even further and trying to destabilize things and taking advantage of those. Natural disasters will still come. I mean, we're not going to, it's not like, nature takes a pause on that stuff. So I think that we're going to be set up, sort of more fragile than we would overall as a system. And so I think that all those things we're trying to take into account, and at the same time, not, go into a hole and shut down the entire process. I mean, we still have full team. We have no intentions to lay off anybody. We want to continue to move forward on opportunities. I mean, we're actively in discussions on a daily basis with companies. But I can tell you that our opportunity cost has definitely risen. And I think unlike VC, which you're seeing, the good deals kind of coming back quicker. If you look at like a 2008, which I think this is materially different in many ways than 2008, but the lower end of the lower middle market really didn't reprice for about 18 months. And deals really didn't start, coming online that were, I would say, a high quality for probably 3 years. I mean, that's brutal to think about, right? And so I think that there is a danger that if you've been in the mode of fundraising, I mean, look, we just completed a fundraise. The timing was fantastic, and we have a 10-year horizon on that capital. We're in no rush, but we're also open to opportunities. I mean, I think is how we sort of the posture we're taking. The issue ends up becoming, and I said this earlier, is selection bias. It's like if you have a great company right now and you don't have to sell for some reason, you're just not going to. I mean, you're not going to sell. I mean, there's just no way. And the government's providing sort of the bridge capital needs right now. And so for us, we're just trying to watch and see and have good conversations, build good long-term relationships, be helpful. I've been proud of our team that they've really kicked into gear and tried to, create content that's helpful to these businesses, how to cost cut, how to think about these government programs. The finance teams put out calculators. And then, of course, we've got our own portfolio of 9 companies that we're actively engaged with on a day-to-day basis. And, some are lightly affected and some are more heavily affected. And it's rolling too. I mean, we've got construction firms that will have job sites shut down for a week. Some will have job sites shut down for a month, for a day. It's every day is kind of a new day in what's being allowed and what's not. And so I think that it's such an uncertain time right now that it's really difficult, especially when you're trying to do longer term majority type buyouts. It's just really difficult right now to execute on it. And that's even without us needing to have a bank involved. I mean, we're pretty much, I'd say the only one, but in the private equity, probably the only group that doesn't traditionally use bank financing as part of our transactions. I can't even imagine trying to get a deal done right now and trying to get a bank's attention to get a deal done. Like it's inconceivable. I mean, I talked to a buddy of mine who runs private equity, sort of all private investments for a large endowment. And he said he just considers private equity to be shut for business and real estate to be shut for business. Obviously, I don't know where VC is, and it sounds like that sort of VCs maybe a little less shut. But certainly, I mean, this idea of opportunity cost, I think, really matters, and ultimately, owners need to understand that it's just repriced. What sort of is the opportunity cost is repriced. I mean, when you've got an Airbnb, taking on mid-teens yielding capital, and you've got United Airlines taking unlevered planes and having low 20s yield on that debt. I mean, it's just got to reprice everything down the market.
Yeah, I think in your world, Brent, it's going to take longer because companies have more optionality, and so there's more negative selection bias, right? If you need to be purchased, there's something wrong. In venture capital, the default is you're going to need to fundraise, and just fundraises go better or worse. But Erik, if in our shoes, I would say the companies that are good aren't going to wait 3 years to go raise money because they can't. Very few venture capital companies can. But if they're good and they're raising now, it was because something recent happened and they were midway through the raise and the fundraise fell apart and now they just have to raise. And those are going to be few and far between. But the good companies are probably going to still come out in the fall. They're going to put the brakes on it now. They're probably not going to even try to raise in the summer. And this fall is going to be a really, really good time to invest probably. And you're going to have a ton of deal demand. And so you're going to have more capital demand than supply. And if I were us, I would just gear up for September and October and November. Those are going to be really, really busy months. But trying to do too much too soon right now, just because you read a bunch of blog posts that said you're supposed to be contrarian and buy on the dip, probably doesn't make sense. And I can tell you, my calendar is pretty empty. If you were to look, usually my day is 30 minutes. If you look at my calendar, you might think I don't have a job. And I'm doing that because one, our companies have emergencies. and I want to keep my calendar open so they can call me on my cell phone at any time. And then I'm not trying to make myself busy. I know that it'll happen. And so anytime I'm just working on, I'm watching workout videos with my fiance and I'm drinking tequila, and I'll come back to investing when things get better.
Isn't that your normal life, Ali? I'm just joking.
Close, super close, but more calendar invites.
That actually is a good question. So Ali, what do you think, how do you think coming out the other end of this, what you've learned during just on personal habits, like time usage, how do you think your life will look different as a result of this sort of more permanently, or do you think it will at all?
So I have a friend who had this great line. He's like, yeah, I keep telling people that I can't deal with that right now just with everything going on, but I'm not that busy. And it was pretty funny because what he really meant to be saying is you do all the stuff that you get asked to do because you feel guilty not doing it. And we now all have an excuse to not do stuff. And it's like a really believable excuse. And it makes it so that we're all kind of actually opting in instead of getting pulled in and sucked into stuff. So I've been only doing things that I actually want to be doing, having said yes, knowing that I had the choice to say no. It really makes me wonder what my ability to say no in the future will be. So yeah, I guess time management. I'm also spending a lot more time with our portfolio companies and I'm loving it. It is really fun to sort of get under the hood a bit more instead of doing everything in 20-minute increments. And I'm also finding myself talking to people I haven't caught up with in a while, and just having time to do that.
I was going to say, that's the same thing that I've been experiencing is just having a more open calendar and less sort of busy stuff that I've been doing has really opened me up to have deeper conversations and be able to linger when you should linger. And I think not being rushed to go from one thing to the next. I really hope that I'm able to keep that. I mean, we'll see when life comes back, snaps back, what that looks like. But it's definitely given me a hope that maybe I can eliminate some of the hurry from my life that I think that had crept in. And also, I eat so much better now that I'm not eating out. It's incredible.
Oh, Keelan's got me in the Whole30 diet. I'm worse.
You're going to be weight for thick here in a month.
Totally.
Unbelievable. I just want sugar so bad.
When you have a full calendar, every bad meeting is too long and every good meeting is too short.
Yeah.
And as Ali mentions, it does have sort of this hell yes or no dynamic of really being focused. I thought I was going to have kids to be able to have an excuse to get out of stuff.
I've just made it up. I just tell people I have kids.
But now there's much easier reason. But it allows me to linger as you mentioned. Brent, you mentioned earlier this is different than 2008. Let's double down there. I'm curious let's double click there. I'm curious because some people say things like, hey, our economy was structurally sound. As soon as this gets back to normal, we'll have some sort of recovery. Some people say, hey, even if our economy was structurally sound, you can't just you can't just pause for 2 months and go back to the way things were before, assuming the virus is contained or doesn't flare up in a way that causes us to separate again. And other people say, no, we were actually our economy was not structurally sound, and something like this was going to, whether it was a virus, whether it was something else, was needed or was going to happen to sort of reset. Where's your stance?
Yeah, I mean, I think this is made mostly of our own choosing. And by the way, if you hear screams in the background, no one's dying. It's just I have 3 girls under 6, so I actually have kids. And
you have the excuse, yes.
Yeah. So anyway,
he's just got a recording in the background. Actually, it's just like a radio.
Yeah, exactly. Different pitches.
You're trying to end the conversation. I'm just kidding.
Yeah, I mean, I think I made a comment in one of the pieces that I'd written that it feels like a combination of prohibition and eminent domain is kind of what we're going through right now. And I am not smart enough. I'm not a macroeconomist. Well, I don't know what's the phrase that economists were created to make astrology look legit. But I'm not smart enough to know, sort of all the underlying reasons why something could go wrong. I can tell you that the situation we're in now, I mean, we had a pretty good beat across our companies on the economy, and the economy going into March was fantastic. Things were going well. Demand was fantastic. The labor markets were really, really tight, but look, stuff was getting done. And, it has just gone off a cliff. I mean, I don't know. I don't know what to say. I mean, it's not like this is it's not like people over levered. It's not like there was some contagion that, man-made contagion, right, that hit the market. I mean, this feels like we are in a situation that it's much closer to a natural disaster, but it's just a natural disaster that's hitting the world all at the same time. And so in terms of the recovery out of it, I mean, I don't think there's a playbook coming out of this thing. I think that there is, going to be just a material difference in certain types of demand. I mean, when you have the government standing in front of you saying, don't get close to people, don't travel, it's going to take time if everything, let's say, we create a vaccine and everything returns to normal, quote unquote. It's going to take a while for people to sort of have that muscle memory, go back to something closer to what it was before. I also think that it's shown that there is a lot more latent risk in the system than a lot of people were seeing. And so, my guess is that savings rates sort of increase, risk tolerance decreases just in general. And I think that will ripple through the economy. I mean, if you're a business owner and you say, I could buy that piece of equipment, but I think I'm going to buy it used instead of new, right? I mean, that has, I'm going to fix stuff that I have that maybe is not optimal. I'm not going to hire those 2 extra people that I think I could really, expand. I'm going to sort of just, we're going to be a little leaner. I think those things in general do have an effect on the economy. And I think that we're headed, my best guess is that we're headed to rolling lockdowns, I think, until we have a vaccine. And I think those rolling lockdowns will be by geography. I mean, the United States is so big, and you can't, sort of, it's not a monolith, right? I think there's going to be, rolling lockdowns in large cities or in regions. And then until there's a really effective therapeutic or until there's a vaccine, I think that we're in this weird no man's land. And I think that could last for, 18 months, 2 years, maybe even a little bit longer. And I think that's sort of the new normal that we're headed for is a sort of, in general, broadly decreased demand, just based on those sort of factors, sort of lowering productivity and then higher savings rates. I mean, I think will ripple through most everything. There are going to be, call it 5 to 10% of businesses that get a tailwind or are sort of largely unaffected by this. But I think the vast majority are going to feel it in some meaningful ways.
Yeah, I think also to that point, you're going to see a lot more companies set themselves up with variable costs, as much as they can. So, you're seeing the resiliency of e-commerce right now over physical retail. I think people are going to really decide, do they need a store to sell stuff? I think that may never change, or that will have changed and never gone away. I agree with you. I don't know that this is like a going back to normal, but I do think it's also important to kind of think about what if it does, and just sort of have the playbook for each part. What if things go really well and have that playbook? What if things go really, really badly and have that playbook? And just lean into the I don't know factor.
Yeah, that's what we've encouraged all of our companies. We've encouraged them that what are plans for X decrease in revenue, Y decrease in revenue, what are the trigger points based on how long this thing goes, so that everything's mapped out ahead of time, so you don't have to think about it. You've already sort of given it the calm thought, and then coming out the other side of this thing, it's the exact same. It's how could we potentially use this crisis for good, to consolidate, talent that we never thought we'd be able to access to, some assets, whatever those may be. I think those things on both ends, on the way down and on the way back up, look important to be able to plan out with the humility that you just don't know.
Yeah. The other, KPI that I think is going to come out of all of this is, when you're thinking about what you're going to pare back on in terms of spending, what's the value of all the stuff that you pay for? So one of the KPIs that I always tell people that my iPhone's the cheapest thing I own, because what I paid for it compared to how much I use it is unbelievable. And then you start thinking how cheap is Spotify relative to utility? How cheap is Netflix relative to utility? How expensive is a car relative to utility? And you start to think about this sort of utility versus spend, and especially when you start seeing also parts of the ecosystem that really gets affected. So, you start thinking about consumer demand, even consumer lending, subprime. People are looking at that being wow, the default rates in subprime are going to get really high. The reality is they've already been really high, and the sad reality is for subprime and deep subprime, life's a recession, and then for super prime, they're probably going to be okay. And it's a bunch of people who are sort of sitting in their apartments and getting delivery and are feeling okay about it. It would maybe with a deep sense of guilt, which is, I definitely feel deeply guilty about what's going on in the world and the fact that we're, Keelan and I are safe and everything like that. But the people that are going to really affect are the people in the middle. It's the people who are good borrowers, they're good spenders, and they've spent their whole life following the rules, even though they're kind of hanging on the edge. And they're the ones who are going to really be making sort of significant changes. So when you're thinking, when we're also looking at the demand and the revenues and the customers of our portfolio companies, the first thing we did is we said, please send us a list of every single one of your customers broken down by the industry they're in. Do you have are all your customers in the travel and hospitality space? That'd be really bad. Are they SMBs? That'd be really bad. Are they financial services institutions? That wouldn't be so good. And then understanding of those, which are the middling credits, because the good credits will stay the good credits, the bad credits will stay the bad credits. It's the middling ones that are, sort of worrisome.
Totally. Yeah, I think it's interesting analyzing consumer behavior and also enterprise behavior in terms of, are they going to freeze new business expenses? Are they going to embrace new ones that, are cutting costs in a way that they wouldn't have before?
An enterprise sale will probably get hit harder than consumer subscriptions because I don't see people turning off Netflix and Spotify right now. And Spotify and Netflix are not going to give you a discount. They just don't care enough about you. But I know that for all of the enterprise software that we use, we're getting pretty good discounts. Our portfolio companies are getting good discounts, and people are trying to take care of their existing customers. So we'll see. I think different companies will be affected in different ways. And anyone who thinks they have the answer is I am excited to see how their predictions end up.
Yeah.
One of the things that I think that might end up being sort of a long-lasting thing is digital community as being much more important than it's been in the past. I think it's been sort of an augmentation of sort of real life community, in-person community. I think that these digital communities that are being formed, I think that you'll see a lot more of these formed that will enable a level of intimacy and true community that maybe haven't been there before. So I'm actually excited about that part. Prior to this, I was not a heavy Zoom user. I'd used Zoom, a couple times. And I got to be honest, I think we might travel less in business just in general. I think it's still a signaling mechanism to show that you really, really care and that it's, a relationship's important. But I think that the actual utility of it, you can bypass a lot of that and use sort of digital tools in a way that could create a lot higher productivity. I think it has obviously implications on certain industries, but I think in general, it could be a really useful thing long term.
Yeah, I'm a little nervous about how many digital communities are going to exist. I remember I was already overwhelmed with how many Telegram groups I was in. And that was crypto Telegram groups were really mania. And I don't really need one more Slack channel. And I'm, I've already been there's already a couple of Zoom groups that have now formed. And they're cool. They're really cool, but it is a lot of content. The challenge is saying that you can't hang out. I don't know if you guys have experienced this, but someone's like, hey, do you want to Zoom later? And you're like, I'm available, but, I kind of want to just read. I don't know. So it's really hard to get out of stuff right now in a weird way socially.
Just tell me you have kids. You can't do it.
Yeah, no, it's I was talking to a friend and I was like, I was about to say I have to go. And I didn't have to go. I just wanted to go. And I was like, hey man, this can be pretty bad, but I'm kind of out of stuff to say. Yeah. And I'm just going to go watch TV now.
That's funny. Let's go with the LPs a little bit. I feel bad I have some friends right now who are trying to raise their first venture fund when COVID hit. And if you were trying to raise a venture fund, especially a micro fund in 2019, that was the best time ever. And so many micro funds got off the ground. But now, on the endowment side, they were already over allocated to venture to, illiquid portion, they're getting crushed. People, universities, obviously don't have students there. Students are now realizing they're paying all this money for Zoom calls that they don't even want to be on in the first place. Parents are seeing them, at home and saying, hey, why are we paying all this money? Our class is going to reopen in the fall. I don't know. So that means they need more money for
LP markets are shut. If you're trying to raise a fund right now, it is a really bad idea to call people because you're going to get a no, and you might as well wait a few months and then reopen the fundraise because a maybe later is better than a pass. So how about this? If you are raising a fund right now, it's because you're it's special. And so I'm sure that the funds now, if it's another fund or if it's a re-up or if you're an established firm, people are going to invest. They'd rather you wait, but they're going to do it because they know they have to. If you're an emerging manager, I would strongly discourage it. The other thing that's happening, especially for endowments or anyone who has an endowment type model or they have buckets, is your equities just got crushed. And so you need to rebalance. And so let's imagine you had $100 of stuff, of money, and you used to say, well, I want a certain percentage in equities. you now have all of a sudden, like if you had, I don't know, 40% equities, let's call it, you now have 30% equities. And so you now need to take the money out of other stuff and put it into equity. Or if you used to always want 60% of your book to be liquid and 40% to be private, if your liquid book just got marked down, but your private mark didn't, then you have to take money out of the private market and put it back into the public market to hit your targeting goals. So not only are people not wanting to invest because they got hit and they're reticent and nervous, but it's also that they're having to rebucket into things away from you. And there's just too many headwinds for now.
Yeah.
Well, luckily, private markets have a lot of dry powder, but.
Yeah, I mean, I think that also how LP behavior you think is going to rebound here in 6 months to 12 months will also affect how GPs handle the dry powder that they currently have. I mean, that's one of the things that when this thing all started hitting, we called all of our LPs from the most recent fundraise and said, "Hey, I just want to verify you're still with us, right?" And we got resoundingly hell yeah. And in fact, we had 2 of our larger LPs say, "Hey, if you've got stuff that comes up as a result of this, we'd be willing to put in more." But those are the types of LPs that, I mean, we obviously selected for heavily and bought into sort of the long-term vision. A lot of the people that we've talked to that are on the LP side, I mean, it is, as Ali said, I mean, it's just shut. I mean, there's just no way that they're going to be doing new commitments right now. If you think about all the factors of why most GPs are shut right now, it's sort of an echo up the chain of why LPs are being shut. Same. I mean, they're dealing with triage the same as everyone else. I mean, you better believe that LPs are being active in the portfolio with their GPs, trying to help triage and understand where you're going to try to put your capital to save some of these companies as well. I think those are the discussions that maybe if you're raising a first-time fund and you don't really understand those dynamics, it's going to be hard for you to understand why when you reach out to somebody, they're saying, "Hey, I'm booked up. There's no way." And so I think, again, how risky, where do assets flow in a risk-on environment? I think that's a really interesting question. And I think that, again, I'm not smart enough to know that, but I think it does have implications of how quickly will some GPs deploy, knowing that it may be hard to raise no matter what their track record is on the back end of that.
Totally. Let's spend the next 10 closing minutes just talking about predictions or certain industries that we're excited to see different trends or accelerants. I have 2. One is something I'm excited about. Another is something I'm less excited or I'm curious about. So the first is education. I invested in a homeschool company. I invested in a daycare company. I think the sort of shift from K to 12 to something new, or the shift from university to something new because it's wildly expensive, I think is accelerating quicker because of this. And I'm excited to see entrepreneurs create solutions to solve that. So I'm looking to invest there, and not that it's on the university level. It's not that it's bad. It's just that it's way too expensive and people are taking on way too much debt. And so that's a space I'm really excited to see more solutions. I think one space that I think has not performed as well as it should have is crypto, is Bitcoin. I think people were saying, hey, this should be a flight to safety in these types of situations. Then people were saying, hey, not for these types of situations, but for other types of situations. But then with the Fed printing X trillion dollars, I think people are sort of understanding. You're learning about geopolitics and how strong the dollar is and how they can effectively get away with it in a way that doesn't seem to impact Bitcoin. Bitcoin pricing or Bitcoin prospects. And so I wonder what that means for people's understanding of Bitcoin.
On Bitcoin, I was super bummed by how it performed. And I don't really have an opinion formed other than it didn't do what it was supposed to do. And that the government has shown that it's probably a pretty useful thing. It's probably pretty good that the government told everyone to go home. And it's probably pretty good that the government made a bunch of loans to people. And monetary policy is important, because when you see deflationary events occur, then that you can go print money. And I didn't really have a positive or negative view of Steve Mnuchin ahead of this, but I think he's done a pretty good job. And he had the benefit of, seeing Hank Paulson fight really, really hard to get all this stuff done before. And I don't know, I feel better about having a government than not having one. The second is, we're really focused. So I think a lot of, investors are saying, okay, what changed about the world that's going to stay the same after all this is over? And I think one of the things we're trying to stay away from is avoiding any deal where, because of the pandemic, the revenues are up and they're wow, we're sort of counter-cyclical. you're not countercyclical. Like a pandemic happened, and this is like weird that you're good at being remote, but that's not like a countercyclical investment. That's like a pandemic cyclical, countercyclical investment. And so those deals like aren't really that attractive to us, because at the end of this, they're going to have a really big bump in Q2, and then they're going to go back to being the normal mediocre companies they always were. I do think that there's certain things that, like, yeah, of course, like stimulants. Like I think Lambda School is probably, pretty happy about this. I think income share agreements are going to get fucked. And so I'm glad I'm not in those. Zoom, will probably matter. And we have, Keelan and I have really close friends in Atlanta that we almost never talk to, or at least I almost never talk to. She's better at getting on the phone than I am. And we're talking to them we're hanging out with them every weekend now. So I think that's really cool. Brent, I bet you feel like even better about not living in New York now. I think that, it's really in vogue to say commercial real estate probably won't come back in the same way. I don't know. I bet you like less undergrads are going to like graduate from college and say, no, what I really want to do is go to New York City and San Francisco. So I don't have any like really groundbreaking things other than if anyone sends me one more deal that tells me like, oh my God, I have this portfolio company that's doing amazing because of the pandemic, you should totally invest. I'm not interested in that. Like I'm interested in companies that are going to be good in good times and bad.
Yeah. I would say that the thing that I'm interested in is telemedicine and how that kind of comes out of this. Mm-hmm. So one of a friend of mine runs a local group that he's been trying for years to work on state licensure type stuff. It's really difficult. I mean, you have to get licensed in every state to practice medicine there. The argument is that, the Texas, there's something about, practicing medicine in Texas that's just fundamentally different than practicing medicine in Wisconsin, right? And you got to have local knowledge to know, and you got to make sure that the people that are practicing in Texas know Texas people as if they're different than Wisconsin. I think a lot of that BS is going to go away. I mean, one of the things I'm really hopeful for is even beyond telemedicine, that a lot of this just state licensure stuff, just to have to braid hair or to do whatever. A lot of this stuff gets opened up and is seen for what it's always been, which is to try to protect incumbents. And hopefully we just like clear cut a whole bunch of that garbage that has been impeding really, for the most part, the poorest entrepreneurs amongst us from being able to do their business. It's just a giant tax on small businesses. So I'm really hopeful that that's going to open up, and specifically in telemedicine. I mean, I think there's so much stuff that we do, that we've done previously that's like urgent care type work. A buddy of mine's a good friend of mine's a doctor, and he said before this he had done maybe one or two telehealth visits, if you want to call it that, in his entire life, and now he's doing 10 of them a day. And he said, actually, I'm a lot more productive. My clients don't have to drive to and from. We don't have infection issues within the office. I think there's a lot of benefits to it, and so I'm pretty bullish on that. There'll be a whole crop of organizations that pop up that can provide a sort of meta layer of truly fantastic health services, through your phone, in essence. I think areas that I'm interested to see how they play out are really heavy asset industries. I mean, this is sort of going about as far away from tech and VC for the most part as you can. But I am curious, if you can take the aviation industry, I think it has incredible consequences up and down the chain if you have a sort of 15%, let's call it, material and sustained difference in air travel. Sort of taking air freight out of it. It has implications up and down the supply chain. How often these parts are being produced by companies. I think there'll be a lot of niches that are created, as a result of it. But I think it's going to be pretty damaging to these large companies that have this incredible infrastructure and footprint. And so that's another area that we're watching pretty closely right now is pretty heavy asset type industries and companies. Heavy manufacturing, I think, is really interesting. I mean, the margins have never been great there, but if you take out 10% of demand, I mean, these companies flip from being moderately profitable to being wildly unprofitable overnight. And I think that's where some of these, some of these things are just going to have to shake out. And I think everyone's going to get a big haircut depending on what the industry is.
Yeah. And I want to comment on something you mentioned earlier, digital communities. I feel like it's opportunities for really new social experiences. Like some people are saying, imagine if chat roulette had come out in this era. I worked on a video startup, 2012, that would have loved to see this era. There was sort of a game show type dynamic. This should be a golden moment for virtual reality. It's too early from a tech perspective, but if it was a few years later, I mean, people are bored, looking for new ways to connect and new ways to sort of, share experiences.
Yeah, if you have kids at home, you're not bored. But
well,
I think there is. It's actually interesting. Somebody the other day on Twitter mentioned that they said there's like this big bifurcation right now. If you have kids, you're like working, you feel like, 18-hour days, right? You're going as hard as you can all day long, every day. And if you don't have kids, you're just bored as hell. So, yeah.
Erik, you want to play online poker later tonight?
Yeah, that sounds like a plan.
Erik, you want to play online poker later tonight? We'll invite Brent. He can't make it.
Yeah, exactly.
But,
sounds like a plan. That's a perfect segue. Ali has to go back to see his kids. I know Brent's faking it. My guests today have been Brent Beshore, Permanent Equity, and Ali Hamed of CoVenture. Guys, thank you so much for coming on the podcast.
Hey, thanks, Erik.
Guys.
Good to see you guys.
If you're an early stage entrepreneur, we'd love to hear from you. Check us out at villageglobal.vc.